When you look at the number of infections, when you look at the number of restrictions that governments are imposing in Europe, what are the chances that we now get a double dip recession?
Well, the risk is certainly rising. What we see is a very heterogeneous impact. I think we see a continued recovery in manufacturing. The question is, will this go on now with these rising infection numbers? But certainly a strong blow to services. So for Germany, we don't see a double dip yet, but the risk is certainly rising, no doubt.
What makes you worry about the coming weeks and months? I know we're 8 days away until the U.S. election. How does that change the fortune of German car makers and European exporters?
I think the U.S. elections are, of course, tremendously important, but the impact in the short term is limited. Of course, the medium-term outlook for car makers does depend on whether Trump is reelected or not, but the Democrats are not so much less protectionist. So this risk remains. I think what's worrying at the moment is really the rise in infections. It is unclear what could stop that, and that will have an impact on the recovery.
Clement, it's a completely unfair question, but you're such a trooper, I'm going to ask it anyways. I don't want you to play sell-side equity analyst, but the surprise of the SAP pandemic view, is there more of that to come in November?
I think it's clear that we are going to see downward revisions in many businesses. The question is how strong they are. I don't know. I'm no expert on the IT industry, but the key question is really, can the IT industry insulate itself from this shaky situation? I have to say, I doubt it. But as you say, it's very hard to make predictions here.
It's very hard to make predictions, but then across all of the landscape of Germany, forget about IT, look at the industry, look at small business as well. We have the same issue in America. Are we just grossly misjudging the revenue expectation across our nations?
I'm not sure. So there will be a strong impact of the current situation on everything that's called social consumption. But for Germany, for instance, we are talking about 6% maybe of GDP. So if that declines, the impact is limited. We've also seen that reestablishing the border crossing value chains has worked quite well in manufacturing. So I think we shouldn't be overly pessimistic, but it's clear. I mean, these partial shutdowns we're seeing at the moment don't help. Still, my hope would be that a lot of businesses have prepared and are now ready to deal with the situation and to operate under more difficult conditions.
But, Mr. Fuest, what are companies telling you would be the correct way of dealing with the virus? So the number of cases are going up. Is it partial lockdown? Is it no lockdown? Or is it full lockdown because you get out of it quicker?
I'm afraid there is no consistent answer here. My view is that we need stronger lockdown measures, but differentiated ones, and measures that enable us to do things rather than preventing us from doing. So more testing, masks are very important, face masks. We need to keep the economy going under these conditions.
But, Mr. Fuest, when you speak to manufacturing companies, do they have a different view to services companies? Where's the divide on what companies need and are asking of the government?
I think the manufacturing companies would be worried if there was another closing of borders, if they would have to stop operating. For services is different. I think many services companies are aware that some of their operations, everything related to services with high contact risk, will be affected.
What did you see on trade front? What did you see from Germany on the mood of the export juggernaut?
I mean, that's been driving the recovery. Exports, for instance, from Germany to China are above last year's level. So that's been very positive. And generally, border crossing, value chains, trade has recovered quite well. That's also because manufacturing has recovered in all countries. So that's rather positive.